To understand why this decision matters so much, we need to talk about interest rates. Because interest is essentially the price you pay for borrowing money. And in the US right now, those prices can be pretty brutal depending on the type of debt you're carrying. The average interest rate on a credit card is hovering somewhere around 24%. On a personal loan, you're looking at around 11 to 13%. And on a mortgage, somewhere in the 6 to 7% range, depending on when you locked in your rate. So what does that actually mean in real dollars? Let's say you have $5,000 sitting on a credit card at 24%, and you don't pay it off for a full year. You'd owe roughly $1,200 in interest just from letting that balance sit there. Not from buying anything else, just from carrying the balance. A $10,000 personal loan at 12% cost you about $1,200 in interest over the course of a year. And a $300,000 mortgage at 6.5% over 30 years, you'll end up paying well over $380,000 in interest alone over the life of the loan. More than the amount you actually borrowed in the first place. So yeah, it's very easy to understand why so many financial experts say you should wipe out your debt before doing anything else. The math looks terrifying. But here's the problem with following that advice blindly. Waiting to invest can cost you just as much, or in some cases even more, depending on the numbers involved. And to understand why, we need to talk about one of the most powerful forces in personal finance. When you invest in the stock market, your money doesn't just sit there. It grows. And then that growth generates its own growth. And then that new growth generates more growth on top of that. This is called compounding. And over long enough time periods, it becomes almost impossible to fully wrap your head around how powerful it is. Historically, the U.S. stock market has returned an average of around 8% per year after adjusting for inflation. That's not every year. Some years are higher, some years are lower, and some years the market goes down. But over long stretches of time, that average has held up remarkably well. Here's a simple example. Let's say you invest $100 today and earn 8% in year 1. You now have $108. In year 2, you don't just earn 8% on your original $100. You earn 8% on the full $108. So now you have $116.64. And in year 3, you're earning returns on $116.64. The numbers keep building on themselves year after year, and over decades the effect becomes enormous. Now let's scale that up. Say you invest $200 a month into a low-cost index fund, something that tracks the S&P 500, which is just a basket of the 500 largest publicly traded companies in the U.S. After 10 years, you've put in $24,000 of your own money, but thanks to compounding, that portfolio could be worth around $36,000. That's $12,000 in pure growth that you didn't have to work for. After 20 years, your contributions total $48,000, but your portfolio could be sitting at roughly $115,000. And after 30 years, you've contributed $72,000 of your own money, but your portfolio could have grown to somewhere around $280,000. That's over $200,000 in growth that came entirely from the market doing its thing while you just stayed consistent. And the most important variable in all of those numbers isn't how much you put in each month, it's time. The longer your money has to compound, the more dramatic the results, which is exactly why the question of whether to delay investing to pay off debt isn't just a math problem, it's also a time problem. Here's the honest answer. There's no single right answer that works for everyone. But there is a framework you can use to figure out what the right answer is for you specifically. The starting point is simple. Compare the interest rate on your debt to the return you could realistically expect from investing. If your debt is charging you more than what the market is likely to give you back, paying it off first is almost always the smarter move. If your debt has a lower interest rate than what you could reasonably earn by investing, the calculation gets more complicated. Let me walk you through a real example. Let's say you have $10,000 in debt at a 5% interest rate, and your minimum monthly payment is $150. If you just keep paying the minimum, You'll be in debt for around 6.5 years, and you'll pay about $1,700 in interest over that time. Now let's say you have an extra $200 a month on top of that minimum payment, and you're trying to figure out the best way to use it. Strategy A. Pay off the debt first, then invest. You throw the full $350 a month, the minimum plus your extra $200, at the debt. At that rate, you clear the balance in about 2.5 years, and you only end up paying around $650 to $700 in interest. Then, once the debt is gone, you take that same $350 a month and start investing it for the remaining 4 years of that same 6.5-year window. By the end, your investment portfolio could be worth around $19,000. Strategy B. Pay the minimum and invest from day one. You keep paying just the $150 minimum on your debt, and you immediately put the extra $200 a month into a low-cost index fund earning an average of 8% a year. You do both simultaneously for the full 6.5 years. By the end, your investments could be worth around $20,000, but you'll have also paid closer to $1,700 in total interest on the debt. So what's the verdict? At a 5% interest rate, the difference between these two strategies is surprisingly small. Strategy A saves you about $1,000 in interest, but Strategy B gives your money more time in the market to compound. And in this particular scenario, those two effects basically cancel each other out. This is why the debt versus investing debate is so confusing for so many people. When your interest rate is low, there's no obvious mathematical winner. Small changes, like your actual market returns, your consistency, or exactly how long you invest, can easily tip the balance in either direction. Now let's flip the scenario. Instead of 5% interest, you're carrying that same $10,000 balance on a credit card charging 20%. At that rate, the balance is costing you around $2,000 a year in interest just to carry it. That's roughly a 20% guaranteed return the moment you pay it off. And here's the key word there, guaranteed. The stock market's average 8% return is historical and not promised. But the 20% you save by eliminating a 20% interest rate, that's locked in the second you pay it off. This is why high-interest debt almost always needs to go first. You cannot reliably beat 20% by investing. The math isn't close. Getting rid of that debt is genuinely the highest return move available to you in that situation. Here's something the numbers alone don't capture. Your feelings about money matter. A lot. If carrying debt makes you anxious, keeps you up at night, or makes it hard to focus on anything else, then paying it off faster might be the right call, even if the pure math suggests otherwise. Because financial decisions you can actually stick to are worth more than theoretically optimal decisions you abandon under pressure. And that leads to another really important variable, panic selling. Let me give you a scenario. You've decided the math supports investing while carrying low-interest debt. You open a brokerage account, pick a broad index fund, set up automatic monthly contributions. Everything is going smoothly. Then, one morning you wake up, open your phone, and every financial headline is screaming about a potential market crash. You check your account and you're down 8%. Suddenly, all you can think is that none of this would be happening if you just use that money to pay down your debt. And at that point, a lot of people sell. They pull their money out of the market, often at a loss, and tell themselves they'll get back in when things stabilize. This is called panic selling, and it's one of the most expensive mistakes individual investors make. If you look at the historical chart of the S&P 500 going back to the 1950s, you'll see crashes happening roughly every decade. 1987, the dot-com bubble, 2008, COVID in 2020. Every single time, people panicked, and every single time, the market eventually recovered and went on to hit new all-time highs. The people who stayed calm and stayed invested came out ahead. The people who sold at the bottom locked in their losses. So before you decide to invest while carrying debt, you need to be genuinely honest with yourself. Can you watch your account drop 10, 15, 20% without hitting the sell button? If the honest answer is no, that's important information. It doesn't mean investing is wrong for you. It means you need to build some resilience and knowledge before you're ready to do it well. Before we talk about whether to pay down debt aggressively or invest, there's one thing that needs to happen first, regardless of your situation. You need an emergency fund. Not a someday I'll get around to it fund, an actual, accessible, liquid emergency fund sitting in a high yield savings account. Because here's what happens without one. Life throws you a curveball. Your car breaks down. Your water heater dies. You have an unexpected medical bill. And you have no cushion. So you put it on a credit card, which means you're adding high interest debt while simultaneously trying to pay off debt or build investments. You're running on a treadmill. Most financial educators recommend saving enough to cover 3 to 6 months of essential expenses. If you have kids, an unpredictable income, or you tend to stress heavily about money, you might want to push that closer to 6 to 9 months. The goal is to have enough of a buffer that when life gets complicated, and it will, you don't have to derail your entire financial plan to deal with it. It also makes you a much calmer investor, because you're not one emergency away from needing to liquidate your pant.